Welcome back, traders. Thanks for joining me here today. In the last class, we discussed the channel pattern for the continuation of trends. And I showed you how to apply the channel pattern for the continuation of trends in the market. In this video, I will show you how to implement the channel for the reversal of a trend. To trade the reversal of trends with the channel pattern formation, there are some key factors to have into consideration, and they are: Number 1. Implement the channel for the reversal of trends on the higher time frame. The daily time is a good example. Number 2. Trade channel reversal if such channel reacts at a powerful resistance or support level on the trading chart. Number 3. Combine momentum analysis when trading channels for the reversal of a trend. Number 4. The higher angle of inclination of the channel, the better the channel could lead to a sharp reversal. Number 5. Implement a rising channel for the reversal of a bullish trend into a bearish trend, and implement a falling channel for the reversal of a bearish trend into a bullish trend. Here are the 5 most important factors to take note of when determining the reliability of channels for the reversal of trends. As a trader, remember this is not a guarantee because there's no trading system or setup that is infallible to the market. Now that we know these reliable factors, we can now proceed to learn how this pattern works for the reversal in the market. The daily chart of the New Zealand Canadian dollars here is a great example for us to study. On the left-hand side here, we can see the formation of a strong candlestick bodies by the bulls. Price rallied to the high here, and there was a bearish pullback. Price resumed the bullish trend to form another higher high swing here. There was another repetition of higher low here, but the next bullish leg failed to carve a new higher high here. The bears set in, but the bulls defended the last swing higher low here. The bulls stepped in again, and they successfully carved a new higher high. Next, the bears set in and pulled price to the last higher low here. Technically, we can connect 2 trend lines to capture the 2 upper and lower swings in this market. Technically, our expectation is for price to be rejected upward at this lower trend line here. The bulls failed to defend this trend line, and the bears pulled price out. Now let's study the strong bearish candlestick, which closed below this last higher low swing here. Also, take note of the strong body sizes of the bearish candlesticks from the swing higher high here to the low of the second to last higher low here. This strong bearish candlestick gave an indication of a strong selling bearish momentum. We can see how there was a retest of the broken trend line of the rising channel here. After this retest, the trend resulted in a massive sell-off. Trading the first bearish breakout here is risky because technically the best zone to implement our stop would have been at the last higher high swing here. We could have sold here if there was a lower high swing before the breakout. Therefore, whenever there is an absence of lower high swing before a bearish breakout of a rising channel, it's better to patiently wait for a retest of validation of the broken support as a new resistance for price before selling the rising channel. Here's a falling channel that led to the reversal of the bearish trend here. Price made double bottoms in this market. The second bottom here resulted in a falling channel pattern. Let's zoom in to see the price actions in this falling channel. As we can see in this falling channel, price carved a higher low to the upper trend line of this long-term pattern. A bullish Marubozu candlestick broke out of this pattern. The swing higher low here gave an indication of the possibility that a retest may not occur to this broken upper trend line. We can see there wasn't a retest of the broken upper trend line. If you were to trade this buy setup, the best zone to implement stop loss would have been at the low of this high low, which led to the bullish breakout of this pattern here. Alternatively, conservative traders could have made an entry at the rest of the broken lower high swing here. They could have placed their stop loss at the low of this bullish Marubozu candlestick here. We can see how the bullish breakout of the falling channel resulted in almost 730 pips bullish move. Let's search for another example channel that leads to the reversal of a trend. Here's a rising channel on the weekly chart of the British pound sterling USD. We can see how this long-term bullish trend was reversed into a bearish trend. Let's zoom out to see if this rising channel reacted at a powerful resistance level on the weekly chart. We can connect the low of November year 2005 here to the high of August year 2009 here. Let's zoom in a little bit. We can also connect the series of rejections at the high of 2009 here to the high of the year 2011 here. Now it's visible to us that this rising channel formed at a powerful resistance level on the trading chart. Let's take the measurement of this major bullish trend. From this double bottom here to the peak of this rising channel here is 2,380 plus pips. If you were fortunate to take this rising channel bearish breakout from this last higher low swing here to the support of the double bottoms here, this trade would have bagged you 1,900 plus pips profit. Only a patient trader with enough capital could have ridden this trend to the end. The rising channel is a powerful pattern that can help traders to build a powerful trading strategy and also to bag huge profit if properly applied in the market. Avoid trading this pattern for reversal if it does not form at a key level zone on the trading chart.